Today's topic now is how to exceed the RSP contribution limit. So next slide. All right. So what's the problem? The issue is that 98% of physicians that are using tax sheltered accounts, under the Income Tax Act to save for retirement, are really focusing on one single product, the RRSP. Of course, now many people have TFSAs as well, tax-free savings account. But the RRSP continues to be the main savings account that business owners, including professionals like doctors, are using. The RRSP, out of interest, just for people who might not know, has been around since 1957. And the very, very first RRSP ever created was for the Canadian Medical Association. So doctors, ironically, were the driving force for the creation of the RRSP back in the 1950s. Now, the problem with the RRSP, and the reason why we're having this session today, is that it only provides one tax deduction, one contribution amount that you can make on an annual basis. It has a limit, and that limit is calculated by using a formula that says you multiply 18% of your earned income in the previous year, and then you look to the year's RRSP limit, and the lesser of those two is what you're allowed to contribute to your RRSP. So if you look at the next slide, we have in the middle here, the RRSP dollar limit. We have what this maximum limit looks like year after year. Well, we're starting now, but going back a few years, about 13 years into the past. So you can see that these amounts, unfortunately, are not that high. I mean, they're fine if you're making $180,000, but a lot of physicians, as they progress in their career, will be making a lot more than that, thankfully. And therefore, being able to only put 18% of that sort of 180, 170, 185 level just doesn't cut it. Next slide. So we're really in a race against time, because if the income is rising faster than this RRSP limit, right, and this is what we expect, and that's what we actually see over time with seniority, the amount of capital that is being contributed to this registered plan just doesn't keep up. So that's the real crux of the problem with using an RRSP to create some sort of a retirement plan. The other thing too, the other problem is that the RRSP is what we call a money purchase solution or defined contribution solution. So the way those work is you contribute monies on a defined basis, some percentage of income, like the RRSP, 18%. And then you just hope that this pot of money is going to grow and that it will generate enough cash at the end of the day to live off, right? Sort of a piggy bank approach. But what happens when there's a stock market crash? So you've done your maximum contribution year after year faithfully, you've put your money in the stock market, and then, COVID hits, or China decides to invade Taiwan, or Russia invades Ukraine, and then the stock markets suffer because of that, or some other reason. You're not allowed to top up your account with all the losses you suffered as a result of these market forces. So now you're starting from a lower level, and you don't have as much time now to rebuild your wealth because you're a lot older. So this is a big problem with these types of money purchase solutions. They're fine if everything's perfect for the next 30 years. Fortunately, reality doesn't work that way. Next slide. These RRSPs are also very vulnerable to death. And, Andrea really talked about a lot of the reasons why insurance comes in, because you have huge tax runs and death taxes that apply. And these also apply to an RRSP where you don't have the ability to do a rollover. So upon death, if someone has an RRSP has a valid spouse, it is possible to do a spousal rollover. But a lot of physicians, a lot of Canadians may not have a spouse at death. The spouse may pass away in the same car accident. They may be divorced. They may be single. They may be a widower, a widow. There's all kinds of situations where people with RSPs pass away and can't do a rollover. And unfortunately for us Canadians that are using RSPs, the Income Tax Act is extremely clear on what happens on death. We have what's called a deemed disposition. And the Income Tax Act deems that everything that's sitting in the account is treated as ordinary income. So now what used to be tax exempt becomes taxable to the estate. And since the estate gets all this money, typically it's going to be paying, sometimes over 50%. Next slide. So here's a quick example. Dr. X has done extremely well with her investments inside her RRSPs. She passes away at age 70. She was trying to defer having to pay that tax as long as possible. And now she has $3 million in RRSP. No spouse. So the full $3 million is considered ordinary income. And in Ontario right now, I put this in an Ernst & Young online calculator last night. $3 million of ordinary income, that's 52.14% tax. So that's over $1.5 million that's disappearing to the tax authorities, and the beneficiaries get less than half. So this is a real problem that most people don't even think about. They might have never heard of the concept of the deemed disposition. So this is another big problem with the RRSP. Next slide. Another issue is that when you're investing your assets in an RRSP account and you're paying a advisor, a portfolio manager, or a financial company fees to do that on your behalf, those fees are not tax deductible. And that's because there's a paragraph in the Income Tax Act, which I've stated here, paragraph 1801 AU, that says you can write off your investment management fees when you have an RRSP account. So if we go back to our Dr. X with her $3 million in RRSP, let's assume the advisor charges only 1% on assets. Often it's 2%, but as you get more money, typically you get some discounts. So that's still a $30,000 in fees that can't be written off, right? That's a lot of money that's been taken off the equation that you don't get any tax advantage. Next slide. Now, sometimes people say, well, I'd like to take advantage of my RRSP, and I'm going to borrow some money from my line of credit so that I can get into the market and I can claim that tax deduction for having contributed, the immediate tax relief, plus I've got some money working in the markets. But the problem is the interest that you're paying to the bank is not tax deductible either, just like the investment management fees. So there's no way to leverage these in a more tax effective manner. Next slide. All right, so now we have a pretty good idea as to what the RRSP does. And remember, 98% of us, probably, there's a few exceptions. I see we have some clients on the line in the room, but most of us are using the RRSP because that's how we know. So what are the ways to exceed the RRSP limit, to go beyond that one single annual contribution? Well, one way, and probably the only way, is to make use of registered pension plan laws, to put in place something like a personal pension plan or some sort of registered pension plan where under the law we have access to 7 deductions and contributions to save for retirement instead of just 1. So over a lifetime, what happens is that the pension customer is able to triple, sometimes quadruple, the number of dollars that can be contributed and written off. So you end up with significantly more capital to enjoy in retirement than had you just stuck to the RRSP like 98% of Canadians. Now, a lot of people say this is unfair, it's too good to be true. You know, how come I've never heard of this? And I know it's frustrating. I know a lot of people are upset that no one's bothered to tell them that pension plans exist and that they can be used. But the legislation is a lot older than 1957. The pension legislation in the Income Tax Act goes back to the very first Income Tax Act of 1917. So there's really no excuse for people not knowing that you can use a pension plan. So next slide. So as I said, a lot of people always say to me, this sounds too good to be true. And yet, it's anchored, it's based in the Income Tax Act and the regulations for registered pension plans. There's no magic to it. So how do we get all these extra dollars to work for us? Well, here's sort of a path that you can follow sequentially. So the first one, we'll break down each aspect. So I'm not going to spend a lot of time on this slide, but just quickly, we can do a past service buyback. We can do an RRSP double dip. We can put more money each year than under the RRSP. We can do special payments in certain circumstances. We're allowed to do a small PA offset amount. And then at the tail end, when we want to retire early, we can do a massive terminal funding contribution. So don't get spooked by the terminology. We're going to break it down slide by slide. Next slide. Past service. What do I mean by past service? Well, this is a catch-up payment that the Medical Professional Corporation that's sponsoring the pension plan is allowed to do when, in prior years, this Medical Professional Corporation was paying a salary or bonus to the doctor, to the physician, under the form of T4 income. So let's say, in a given example here, we have a MPC, a Medical Professional Corporation, that was set up 10 years ago, and the company, on the advice of the accountant, for example, paid the doctor 100 grand a year. The rest was either kept in the company or distributed in the form of dividends, or maybe they called Andrea and purchased a policy. So that's sort of how it works. Now, this physician has been able to accumulate $400,000 in RRSPs on the side and has no room left and is 55 years of age. So we set up a pension plan, and the first thing that we're asked is, can you buy back those years of past service, those 10 years where the doctor was paid $100,000 a salary? So when we crunch the numbers based on these facts, we're able to do a corporate deduction or contribution of $93,052. So that's what the past service is. It's monies that the company is putting inside the pension plan to beef up, to increase the size of the pension benefit relating to past years. Next slide. All right, so this RRSP double dip is something that we can do in the year that the plan is set up. So we're allowed, not only are we allowed to do the past service, and I'm going to talk about later the annual contribution, we're also allowed a third contribution that's tax deductible, and this one goes into the RRSP. So it's the RRSP double dip. And the reason why the law allows us to put money in the pension plan and in the RRSP in the same year is because the RRSP contribution for this year, 2023, is based on 2022, so the previous year's earned income. However, the pension contribution for 2023, for this year, is based on 2023 current pensionable salary. So the two systems straddle each other in the first year. They overlap, and that's why we're allowed to do this double dip. Next slide. All right, the third way in which we're increasing the contribution beyond what's permissible under an RRSP is by benefiting from the pension limits on an annual basis. And we are able to do higher contributions than the RRSP. And what I've done here, and I apologize for the fact that the font may be a little too small, but if you see that, you can look at your age from 18 to 71 and pick your age and then look at what the RRSP maximum is, 30,780, and then you can compare it to the pension plan amount that we're allowed to put in. And then we've done the difference, the delta between what the pension plan allows versus the RRSP. So you can see the extra contribution at that particular age that is possible. And then we've reflected that as a percentage of the maximum salary, right? So RRSP is 18%, but you see that as you grow older, that percentage just keeps growing and growing until it reaches its crescendo at age 64, where instead of 18%, we're at almost 30%, 29.57%. So that's pretty powerful in terms of being able to put more money. So when you tally up all of these amounts, we're looking at over $300,000 more money working for you, being deducted than under an RRSP. Next slide. All right, the next law or rule, I should say, that allows us to put more money than the RRSP is the concept of special payments. So these are triggered when the assets that are invested inside the pension plan generate a rate of return that's below 7.5%. So what the special payments are, they're extra contributions to top up the pension plan when the returns are below 7.5%. Now, what's so magical about this 7.5%? Well, it's found in the income tax regulations that govern these pension plans. So it's baked into the regulations. It's been around since 1991. It's never changed. And CRA has expressed in public meetings and consultation with the industry that it has no intention of changing that percentage. So what does that mean? It means that if we invest the assets in a hyper conservative manner and we don't generate that 7.5% rate of return, then when the actuaries, when the financial specialists that we hired to calculate how the plan is doing, do their valuation, they'll say that there's a deficit. And a deficit can either be ignored, so the medical corporation can just say, I'm not paying it. I'm not putting more money in my plan, or it can be acted upon. So if the medical professional corporation decides to top up the missing assets, these are 100% tax deductible to the corporation. So in effect, we've manufactured brand new registered contribution rule by being super conservative with our investments. So that's the beauty of special payments. Next slide. Okay, another small contribution. I'm not going to spend too much time on it, but on top of the higher annual contributions that I've showed you before, on top of the past service, on top of the everything else, the RRSP double dip, the CRA, the tax authorities, also give us an extra $600 that we can put in our RRSP on top of everything else each year. And that's called the PA offset amount, the pension adjustment offset amount. And because it's going to the RRSP, of course, it gives the physician a personal tax deduction. So if you're taxed in the 50% bracket and you put $600, you get $300 back instantly. Now that extra RRSP money could be transferred on a tax-free basis into the pension plan if you wanted to give that money creditor protection, or if you wanted to be able to write off the investment management fees. There's a bunch of reasons why you'd want to do that, but it's a small amount. So let's move on to the next slide. Now, this is a big one. Terminal funding. It's the last of the ones that I wanted to discuss in this little circuit. So terminal funding is legal mumbo jumbo to talk about what happens if the physician decides to turn on the pension benefits, typically prior to age 65. Because, and when I say turn on the benefits, I don't mean stop practicing medicine. I don't mean quit. I just mean stop taking a salary from the Medical Professional Corporation and instead rely on the assets that have been growing inside the pension plan. You can still take dividends to supplement the pension benefits. So the standard of living, the monies that you're pulling out to pay for the groceries and the gas money and all the other things are still the same. But because we've turned on the pension, normally when you turn on a pension early, so before the normal retirement age of 65, the pension is reduced. There's a penalty that's applied because you started collecting sooner than expected. But under the terminal funding rules, what we can do is we can amend the terms of the plan to say, yeah, there's going to be a reduction, but we're going to supplement that with additional pensions, early retirement subsidy pensions, so that at the end of the day, you're still pulling out a lot of money much sooner. Now, the problem, well, not the problem, but the consequence of doing that is that there's going to be a deficit now building up inside the pension plan, because the pension plan is expected to pay more money sooner, but it ain't got the money. The contributions were not made in the past for that extra amount of pension benefit. So what happens is we calculate what this deficit looks like, and we turn to the Medical Professional Corporation and say, pay up, please feed us. So when the medical corporation contributes, it's 100% tax deduction. And the beautiful thing about terminal funding is that the amounts in play can be very large. So our record is a terminal funding of $2.1 million. So imagine not paying tax on $2.1 million and instead redirecting that money into your own pocket, into your own pension plan. So let's move on to the next. So now that I've talked about each point, remember the theme of this presentation is how to exceed the RRSP maximum. So here are how some examples of what each element can add to this common goal. So let's say $95,000 for past service. We put an extra $20,000 in the RRSP on the double dip. On an annual basis, we've got another $200,000 year after year, cumulatively, because instead of earning 7.5%, we were earning 6%. We're looking at an extra $80,000 of corporate tax deductions, a little bit of PA offset amount, $600 over 20 years, and then because we decided to turn on the pension sooner, we're able to give our company a massive $800,000 deduction under the terminal funding rules. So these are all above and beyond what's permitted under the RRSP. So when someone tells you, well, isn't a PPP, a personal pension plan, the same as an RRSP? Now you know what the answer is. Next slide. But there's more. It's not just the contributions, because on top of being able to contribute all this extra money, we can also unleash and trigger extra deductions, which further reduce the cost of saving money under this type of approach. So first bullet, contrary to the RRSP, with pensions, the investment management fees are tax deductible to the medical corporation. So going back to Dr. X with her $3 million RRSP, if that $3 million had been in the PPP, and again, her investment advisor is charging her 1% on assets, that's an extra $30,000 corporate tax deduction for the medical professional corporation. So that's in effect, we're reducing the cost of investing because we don't need to pedal as hard to get to the same destination. And then on top of that, if Dr. X had borrowed money from a line of credit or elsewhere, the interest paid to the lender is also a tax deduction for the medical corporation. So if the MPC had borrowed $200,000 in order to contribute to the plan, maybe for past service, maybe for special payments, maybe for terminal funding, whatever, and is paying a 10% interest, I'm being very negative about the future, with respect to interest rates, well, that $20,000 of interest is a new deduction for the company. So if the company is paying tax at 20%, you do the math. That's the type of tax savings that we've generated using this feature. Next slide. And remember this infamous deemed disposition on death that the RRSP customer will be facing. How do we help? Well, so contrary to the RRSP, here, if the children of the physician on the payroll of the professional corporation, and I'm not saying as physician, they could be part-time, minimum wage clerical employees. If they're added to the pension plan of the physician, and the physicians pass away, maybe they pass away with their spouse, maybe they don't have a spouse anymore, there's no rollover anyway, then unlike an RRSP, the $3 million, I'm using Dr. X's example again, the $3 million inside the plan is not subjected to the deemed disposition rule. Instead, the law considers it to be pension surplus. So the $1.5 million in taxes that Dr. X would have paid, well, her estate, if she's dead, her estate would have paid, doesn't occur with the PPP in this particular case, because the children are also part of the plan, and the plan is not going to be terminated. The plan continues. That's a lot of difference between an RRSP and a pension plan. But I could pretty much guess that no one has ever mentioned that to you. No accountant, no lawyer, no financial advisor. So this is an important difference with respect to how the law treats these different types of retirement solutions. Next slide. So to conclude, if a physician via the medical corporation is able to contribute $1 million more than what is allowed under an RRSP over a lifetime, and then this money, this extra money, is able to grow on a tax-deferred basis within the pension fund over extended periods of time, it's really going to balloon. And remember Andrew's graph showing the tax grind. Well, if there is no tax grind, that money is there. And so really what's happening is that there's an absolute significant wealth advantage that develops in favor of the pension plan strategy over the RSP. And what I really love about all this is that at no point is this extra wealth that we're guaranteeing for ourselves dependent on being good at picking stocks. It has nothing to do with taking risks in the marketplace. All of this comes from a smarter use of the Income Tax Act to reduce the tax grind as quickly as possible and deploy money that would have been taxed into a tax sheltered environment for extended periods of time. And then when the children are involved, pass it, skip the deemed disposition, and give it to the children without any tax burden. So just a quick tie over from what Andrea was saying, these death benefits that are tax exempt that are received are usually used to pay off tax bills. Well, what if there is no tax bill because we have a pension plan? Well, those death benefit dollars can now be enjoyed by the children, the survivors, instead of used to pay off a tax liability. So this is the first point of contact between the first presentation this morning and our presentation now, is that we can optimize the use of pensions with insurance in this fashion. Next slide, I think it's the last slide. Yeah, that's it. So I deliberately made my presentation shorter because I wanted to reserve as much time as possible for Q&A. So over to you, Dr. Tran, for moderating.
Thank you very much, JP, and thank you for making it short so that we have lots of time for questions. So first question, and I think this is an important question, is my accountant has recommended that I mostly take dividends. Can I still set up a pension plan?
Well, you'd have to change that. You'd have to start taking some T4 income. You can still do dividends, but you need T4 income. You need salary and or bonus paid by the medical corporation for services rendered as president of the MPC in order to be in a pension plan.
So if you're taking only dividends, then setting up a pension plan would not make sense. It would only make sense if you do a hybrid dividend and salary.
That's correct, because dividend income is not pensionable. The government won't allow you to build a pension entitlement if all you're pulling is dividends, because a dividend is a right of a shareholder. It's not a right of an employee. T4 income, salary and bonus, is compensation for being an employee. And that's what this is. This is an employee pension plan. The only employee is the doctor, typically. I mentioned the kids, but we wouldn't offer this to the receptionist or to the nurses or anyone else. It's just for the family.
Well, I mean, this relationship of employer-employee is extremely important. This is one of the reasons, actually not one, this is the reasons why the government has not given us physicians a pension plan, because while we are working for the public purse and the state, the governments have always refused to label us as employees. So we are always independent contractors, and I can't remember any provinces that treats physicians as employees. We're all independent contractors. And so because we don't have employer-employee relationship, we were never given a pension plan. So this employer-employee relationship is crucial. This is another good question here. What are the main advantages and disadvantages between a TFSA and a pension plan?
Well, the TFSA is funded with after-tax dollars. So you're not starting with 100 cents in the dollar. You've already paid your tax. And then it's a personal account. So it's not a corporate solution. Only individuals can set up TFSAs. So if you tax at 50%, you're only starting on 50 cents on the dollar, and then you're putting it to work. So that's the disadvantage number one of the TFSA. The second one is that the annual limits are extremely low. So you're only allowed, what is it, $6,500, I think, something like that, for a TFSA. So yeah, the money grows tax-free, which is amazing. That's the one amazing advantage of the TFSA. But if you can only put $6,500 to work year after year, I know the limits are supposed to be indexed, but even if you get 100% rate of return, it's still not going to be a huge amount of retirement income to retire on. So everybody should have a TFSA. They're amazing. I have one, but Would I use that to be my workhorse to fund my retirement? No, it's a complement, but it is certainly not significant enough to really make a big dent, especially for someone who's pulling, $500,000, $1 million, $1.5 million as a specialist, and you're used to a certain standard of living. There's no way the TFSA will accumulate enough capital to provide a predictable, safe, steady stream of income in the future. Now, you could say, yeah, but I'm Warren Buffett, and every penny that I have in my TFSA is going to be invested, in Apple when Apple started, and in some of the great companies that we know of, and therefore I'll be a multi-billionaire with it. Well, good luck to you, right? Maybe not. Most likely not. So that's the issue with the TFSA. It's just a great, but lots of drawbacks.
I mean, clearly the pension plan is, in my mind, the number one thing to do to save for retirement and all those tax planning advantages. And the TFSA would be a very, very close second, right? The RSP is not even it's not even in my vocabulary anymore. So I can definitely see the advantages and the attractiveness of the TFSA. So here's a few more questions. I think these are more sophisticated questions here. So does the terminal funding apply to physicians between 65 and 70?
Yes, but only partially. So after age 65, the only other benefit that is funded through terminal funding is what we call full indexation to the consumer price index. The basic pension, when you start off with a pension plan, like with the PPP, CPPP, provides built-in an inflation protection of CPI minus 1%. So if inflation is 10% one year, the pension will be adjusted by 9%. So you get a bump in your annual or monthly pension benefit. In order to take it from CPI minus 1 to full CPI, you'd have to do terminal funding. So that's the only, we call them in, again, technical, legal, mumbo jumbo. We call it ancillary benefits. So the full indexation is the only ancillary benefit that can be funded by terminal funding after 65.
Thank you. Is there an income threshold for children to earn in order to be made members of the pension plan?
So in order to justify to CRA that the children are employees, you'd have to pay them the annual rate has to be minimum wage, the minimum wage in your province. Now, you don't have to pay them on a full-time basis. You can pay them on a part-time basis. And, we run the math, and you can get away with paying up to, I believe, $11,000 in Ontario to a child without generating any personal tax consequence for the child. So the company gets that $11,000 deduction. The child pays no tax on the $11,000, and because it's minimum wage, it qualifies. So that's sort of the ballpark. You could go a little bit lower. The question is, you don't want to go so low that CRA can doubt the existence of an employment relationship and say, oh, you paid your child $1 per year. Is that truly an employment relationship? Or is this a scam to avoid paying the $1.5 million in taxes on death? So, we always counsel our clients to be smart and to not go too low. It has to smell right.
Okay. So this is a very, very sophisticated question here. So I'm going to pose it, and it may be a few layers of answers here. Please outline how I could use cash from a real estate corp to contribute to a pension plan set up in my MPC. would this allow me to write off contribution from a real estate corp to avoid the income tax on rental income for that portion?
Okay, this is a great question. So yes, actually, it's quite simple. If the rental corporation, let's call it the real estate corporation, is not the medical corporation, it's some other entity. Under one single PPP, we can have multiple corporations participate. So it would be possible, so long as this second employer, the second corporation, the real estate corporation that's generating all this rental income, if it starts to pay salaries for management or for being the president of that company to the physician, then that company would have the ability to contribute to the pension plan. And the reason why this is important is because follow the money. If the real estate company has rental income coming in, that's taxable to the company. But if now, because we have a pension plan, we have an offsetting deduction for contributing that money into the pension plan, when the real estate company files its taxes, it's got credit and debit. It's got rental income taxable, pension contribution tax deductible. So at the end of the day, if the amounts are the same, there's no corporate tax owing for the real estate corporation. In effect, we've deferred that taxation by punting it inside the pension plan. So that's one way. Now, if you really want to get super complicated here, it is possible as well, and I've seen it done, where all the salaries that gives us the right to make contributions to a pension plan were in one company, like the MPC, and there was never any salaries paid out of the rental corporation, of the real estate corporation. So technically, that company is not allowed to contribute to the plan. So how do we fix that? Well, if you amalgamate the two companies, the cash from the real estate company is what's going to fund the obligation of the MPC for its contribution to the pension plan. So that's another way. I mean, there's so many different ways to do it. I don't want to get into a tax law treaty, but treaties. But there are ways to lend money. One company can lend money to the other corporation, and so forth and so on.
Okay, so here's a good question. How is pension contribution limit calculated? How is it determined?
So if you remember the slide that I showed when I talked about higher annual amounts, you could see that as the plan member's age increases, the percentage of salary that's contributed to the pension plan also increases, went from whatever percent all the way to close to 30%. Those percentages are calculated and driven off of actuarial formulas. So we rely on actuaries to crunch the numbers and to tell us how much we're able to contribute to the pension plan. And the way that the Income Tax Act is written is it says, whatever the actuary tells you you're allowed to contribute to this pension plan, that's the tax deduction that we'll allow. So it's almost like the government outsourced to the actuarial community the methodology to determine what you can contribute to a pension plan. It's a bit odd, but that's how the system is structured. So it's a good question. It's a simple question. It's a hard answer. It's a difficult answer because it's very complicated actual formulas, which, to be honest, it's above my pay grade. I've seen the formulas. I don't really understand them, but it is all done by actual calculations.
Okay, so people smarter than myself for sure.
Or myself.
So I've got one question, because you've kind of addressed the deemed disposition. You've addressed it for death, but are there other deemed disposition that, you know, physicians are not aware of, but it's important.
Yeah, yeah. Well, the other big one, which may or may not apply, is if you decide to become a non-resident of Canada. So a lot of successful business owners that are clients of ours will leave Canada and say, you know what, I built myself a villa in the south of Portugal or south of France or in Florida, California, Arizona, and I've been going every year. Now I want to pick up stake. I want to become a full-time resident of that other jurisdiction. And what these people don't know often, or they find out in the last minute when they talk to their accountant, is that there is another deemed disposition called the departure tax. So the departure tax is, again, the same concept. You're deemed to have disposed of your assets before you became a non-resident. And now you have to pay the tax authorities, even though you didn't sell anything. All you did is cross the border. But the law is this fiction. The fiction is that by crossing the border and become a non-resident, by no longer being a resident of Canada for tax purposes, it's as if you had renounced your rights to Canada and you have to sell everything notionally and now pay the government for one last tax bill. So it's heartbreaking for a lot of people who didn't plan for it. The good news is that both the RRSP and the CPPP is an exempt asset under those rules. So again, using Dr. X's illustration, she had $3 million in her pension plan. If she crosses the border and elects to become a non-resident, there's zero tax owed on that $3 million PPP account. So that could be a quarter of that typically would be the tax bill. So whatever a quarter of $3 million is what is saved by this doctor because she had the forethought to use a pension plan. Now you might say, yeah, but hey, if she had kept it in an RSP, it's the same thing, right? Well, true. The RSP is also an exempt asset. But remember what we talked about during the session. If I'm allowed to put an extra $1 million to work in my pension plan over an RSP, that exempt status exemption is going to be a lot more valuable to me than if I only had a fraction of that money to protect under an RSP. So yes, both are exempt, but if you can put significantly more money in an exempt sort of designation, you're getting a lot more mileage out of the pension plan.
Okay, so I'm gonna entertain one more question, and this is a so MD Management and Scotiabank. So I don't know if people know, but Scotiabank purchased MD Management. So MD Management is no longer owned by the doctors; they're owned by a bank, and they're coming out with a plan called Medicus, which is a multi-employer pension plan. It's a pension plan, but it's not an IPP, individual pension plan. It's not a PPP. It's not a personal pension plan. So it's not for the individual. It's a group plan. So do the same rules that you've just talked about apply? What's the difference here?
Oh, okay. I only have 4 minutes, but
I give you 4 minutes, JP.
Yeah. Okay. Elevator pitch. So some rules apply, like the fact that contributions made by the medical corporation to this Medicus structure are tax deductible to the company. So that there's some similarities. But a lot of the good stuff that we've been talking about doesn't apply. So for example, the concept of this intergenerational wealth transfer, being able to pass wealth from the physician to the physician's children that are participating in the plan by turning money into surplus, that doesn't apply under Medicus. Because under Medicus, if you die and you don't have a spouse, your money goes to the other doctors. It forms part of the pool. So you've given millions of dollars to strangers, which I guess is fine if you love your fellow doctors, but I think a lot of our clients would prefer giving it to their own children than to strangers, even if they're doctors. So that's a big difference. The other one is that while the contributions made to Medicus are tax deductible, they're not using the limits of the pension plan that we're talking about. They're using roughly the RRSP limits, slightly better than using what are called the defined contribution limits, which are about $780 higher than the RRSP limit. So they don't have the ability to triple or quadruple the tax deductions that we have. They don't have that because their plan design uses a defined contribution / RRSP system. So that they're like the first limit that we lacked at the very beginning of the slides, this 18% of salary up to a limit. So therefore, the power in terms of putting money to work in a tax sheltered environment over long periods of time just isn't there because they don't have the capital. They're missing 3/4 of the money that we are putting to work. So they can never achieve the same results than what we're doing. You're on mute. There you go.
Yeah. So thank you, JP, for that answer. I think that's a good way to end this particular topic about RRSPs and its limitation, but also give people a chance to understand what pensions are. There's definitely a lot of questions and a lot of nuances between these, and today is not the time to discuss all this, but thank you very much for helping us understand the RRSP.
My pleasure.